All BDCs are not the same. Performance can vary widely.
Where you really see the differentiation is in the manager strategy.
Diversification's table stakes.
It's really important to evaluate both sides of the balance sheets.
Most wealth investors access private credit through a BDC, the basic building block of the private credit portfolio. These funds are regulated with standardized features and uniform leverage limits. But performance can vary widely. And for this, I'm joined by Seth Painter, Head of Capital Solutions, and Steve Rubinstein, Senior Portfolio Manager in the Asset Management Group here at Antares. So Seth, how do BDCs differ from one manager to another?
Well, most BDCs will be structured similarly for items like leverage and eligibility criteria. That's driven by the regulators. Where the differences really show up is in the manager's strategy, so their risk appetite, their ability to deploy, and whether or not they have workout capabilities. And I think there's another often overlooked differentiator, and that's on the funding side of the BDC's balance sheet and having expertise in the funding market. So the CLO market, the IG bond market, having strong relationships with the banks, that allows us at Antares to create a very attractive cost of capital, and ultimately that drives higher returns to our investors.
So what does an efficient capital structure look like in a BDC, and how does that affect returns?
To me, an efficient capital structure is one that really fits the profile of the portfolios. So for example, at Antares, a portfolio is going to be a bit more conservative, it's going to be high quality, it's going to be first lien, it's also going to be very diverse. So that type of profile really lends itself to the CLO market, and it lends itself to the bank market. And we will, of course, also access the IG bond market just for diversification of funding sources. But to us, we're ultimately trying to solve for that funding mix that creates the lowest cost of capital, and that's the funding profile that makes sense for us.
Steve, turning to you, what are some of the key trade-offs between a traditional illiquid private market fund structure and a more liquid product?
The biggest difference is really the capital called. I think investors are really starting to learn that you don't have to have 100% of your investments liquid 100% of the time. A traditional drawdown fund, you might have your capital called over a 3-year period, whereas a BDC will give you periodic liquidity options. BDCs are required to distribute 90% of their income on an annual basis.
We actually principal invest alongside of our investors. So any loan that goes into one of our BDCs or one of our other funds also goes into one of our portfolios where the employees are invested. It demonstrates that we are being more selective in the assets that we're investing in. We're not simply in pursuit of growing our assets under management.
Let's talk about how to understand leverage in a BDC. How levered are these funds, actually, and how does Antares approach the management of leverage overall?
BDCs are very conservatively levered. There's a regulatory cap of 2 times, and most in the marketplace, including Antares, operate their BDCs at 1 to 1.25 times.
BDCs have the leverage limit, but there's other ways that managers can create leverage in the fund. So BDCs allow for 30% of the portfolio to be in a non-conforming basket. So what does that mean? That means that 30% of the portfolio can be invested in assets that are not loans to US middle market companies. So some managers will use that 30% to invest in things like CLO equity, or maybe it's a joint venture, or maybe it's some other levered structured product. So 2 BDCs may have the same headline leverage, but they may have very different risk profiles.
There's growing emphasis on minimizing exposure to broadly syndicated loans, or BSLs, in private credit portfolios. Why is caution around BSLs so important?
These BSL loans are still high-quality companies, but as a result of that liquidity, they often tend to have tighter spreads that likely results in a lower yield for the investor. In addition to that daily liquidity, it comes with the potential for mark-to-market risk, which could impact the volatility and NAV of the BDC if the allocation is materially above 10%.
So we've seen increased discussion on rising levels of non-cash interest or PIK interest or synthetic PIK interest in private credit portfolios, and the extent to which this may or may not be a leading indicator of stress in a portfolio. So how should an investor scrutinize levels or use of PIK in a portfolio?
We're first lien lenders. We're supposed to get paid in cash. That's the history, and that's where we should be. And the vast majority of the underlying assets across the BDC universe are still paying their loans in cash interest. Benign use of PIK, that could be a manager who historically has invested in those junior capital investments. It's not necessarily a bad thing if that's part of their stated strategy. Bad PIK is when you're having to defer a % of your cash pay interest to a balloon payment at the end of the loan, often in the times of stress for the underlying borrower and as part of an amendment. The equity analysts in the market actually do a really nice job bifurcating that for the investors. Well, they'll highlight the assets that are PIKing that also have a fair market value below 90 or 85 cents. And that way you're able to see that those are borrowers that are maybe experiencing a little bit of stress and also have PIK interest.
If you could leave advisors with a few key rules of the road for evaluating and managing BDCs, what would they be?
Simply understand the manager's strategy. What have they invested in historically and what are they currently invested in? Need to make sure you understand that the manager is not stretching for yield in a market where spreads have tightened. That could lead to incremental risk and ultimately choppy performance.
And I would just add that part of understanding the manager's strategy is, of course, the asset side and their investment capabilities, but it's also their financing strategy. They need to be able to articulate how they're going to finance the fund and how that capital structure will help drive returns and create liquidity for the BDC.
Seth and Steve, this has been a super helpful look under the hood of private credit structures. Thank you for speaking with me today.
Thank you.
Thank you.